Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, April 13th, 5:39 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market in an uptrend, still excluding industrials, financials, real estate from that, but they have improved quite a bit this week. We'll take this label off if we don't implode tomorrow on these sectors and they stay above their 21-day moving average. Check over here the trend gauge. Market leader still showing bullish, yellow arrow in an attempt to uh, curb any enthusiasm that you think you might get out of leading stocks. It's the rare stock that is breaking out of a sound base and just taking off. And really, what you're seeing is failed breakouts, pullbacks to support, and then a bounce off of support, and then really zero follow through after a couple of days. Decent day today, but on a good day like today, with the indices up the way they were, you'd like to see a bunch of leading stocks up 4, 5, 6, 7%. And you just don't see that today. Leaders are, I mean, they're in an uptrend. They're not in a downtrend, clearly. Uh, they're not breaking their 21-day moving average for the most part. I have plenty of candidates for the 21 over 21 list, but very little in the mean in the way of superior relative strength versus the market. And that's what has us focusing on the indexes lately. Short term, some improvement. Mid caps, multiple closes above the 21-day moving average. Small caps got back above the 21-day moving average today after yesterday's negative reversal. Medium term, we're still bifurcated with the three large cap indexes firmly above the 50-day, the mid cap and small day below the 50-day. And again, this is all still fallout and lack of recovery from the banking liquidity crisis. Long term, big cap indexes above the 200-day moving average. Mid caps trying to get back above. I believe they are above now. We need to see how the week closes. Small caps below the 200-day moving average. So what happened today? Well, basically what we thought we were going to see yesterday with the pre-market gap up based on CPI data was just delayed by a day. And what happened was nobody was really talking much about PPI data as it doesn't have as much impact to the consumer as PPI doesn't have as much impact as CPI does. CPI is a clear impact on prices. PPI, there can be inflation, and then the producers have the option of whether or not they want to pass it on to the consumers. But what we saw today was a huge miss to the downside, which is very bullish on PPI inflation. In fact, uh, the they were slated both on the headline and the core number to be positive and were down. So very big misses. So the result of that was we were basically a little bit negative or flat before this came out at 8:30. We popped a little bit up to about a 0.5%, pulled back a little bit as if it was really nothing to be overly enthusiastic about. We opened about 1/3% higher, went tight sideways for the first 30 minutes, and then that just turned into a trend up day. We broke that level, broke the opening 30-minute level, went up, based again, uh, broke above that base. Three bases intraday that we broke higher on. That's bullish. That's a trend up day. We'll take a look at the charts and we'll see that momentarily. RG7, this is our Revere Growth 7 ETF proxy, up 1.54%. S&P tacked a full percent onto the 0.3% gap up. Nice day on the S&P. Really what it looked like was rotation out of some of the safer sectors and into uh, some of the sectors that had been beaten down in anticipation last week of a coming recession. So quite a bit of rotation went on and some money going back into the FANG stocks, but not into semiconductors. They lagged the overall market again. NASDAQ 100 led by the big FANGs, big cap QQQ names, all the names that you're familiar with. Netflix, Apple, Amazon, Google, Microsoft, uh, Meta, all up between 2 and 4.5%. The laggard was NVIDIA, which finished negative, attempted a breakout intraday that failed as semiconductors continue to lag. But NVIDIA, after a strong run, can't get out of its own way. It's sitting red, bounced at the 21 day today, and then failed to break out above 268 and is sitting right on the 21. We'll take a look at that chart momentarily. Uh, Dow Jones Industrial Average up 1.1%, mid caps up 0.7, Russell up 1.3, Global 60/40 up 0.80. This is with global bond being flat. In-house GROTECTION up 0.82%, drugged down by our enhanced TLT position. We cut a third of it today, just not getting the returns that we wanted. Really, what it is it's a failed breakout of interest rates to the downside, which happened when it was apparent that the Fed, uh, some news that they were going to have to stop raising. Now it's back toward another 25 basis point um, hike. We'll see how that comes out, but we moved that longer term bond into some short term bonds today. And then we're going to talk about this Titan-25. I've been talking about this on several videos, saying the indexes just can't break down as long as these stocks stay strong. And I put a spreadsheet together of these, calling them the Titan-25. Great way to track the big holdings of the big three major big cap indexes. This will tell us if these start to deteriorate, that there's a correction coming on the indexes, and you'll see when I show a snapshot of that spreadsheet. It's version 1 of it. I plan to do some improvements to it. We're also going to go through the sectors. Got a couple people positively commented on weekly chart Wednesday, and I think I'm going to continue to do that. It's a good way to zoom out on what's going on with uh, every chart. Sometimes you get tunnel vision sticking to the daily chart, but the weekly chart definitely puts things into perspective. All right, before this turns into a very long video, we got to get started here. So here's the S&P 500. Show the 5-minute. This is very telling. Here's yesterday's gap up on CPI, failed pretty miserably. Attempted bounce midday, sold off hard into the close. Failure, right? Not so fast. Here's the PPI breakout, very tight for 30 minutes. Breakout, base, breakout, base, breakout, base into the close. Nice day. Let's look at the 60-minute chart here. You can see where we are. We cleared this 41.33 high from March 3rd. That's where we failed yesterday. And we actually got up to 41.50. This was the pre-market high yesterday on the initial reaction to the CPI gap up, and that's where we closed today. But we did clear this 41.33, 41.34 level, so it's a breakout. Can it stick? We'll see what tomorrow brings. Let's go to the NASDAQ 100, which has been lagging. Note we did not break out to the early March highs on the NASDAQ 100. We've been talking about the relative weakness there, led really by semiconductors dragging it down. Very nice day today, though, certainly. Turn the stochastic back up after coming off of overbought. That's a big plus. But we're still in a trading range on the NASDAQ 100. Let's go to the Dow. Dow hasn't broken out either because of this weakness that it experienced not only in January but also in February, showing the relative strength. So breakout from the last 2 weeks, but not from January and February. Continues to be strong. Going to get hit a little bit tomorrow after hours. Boeing down about 3% on delayed deliveries of the 737 Max because of a parts issue. I swear that company, it's like a biotech. There's bad news coming out constantly, setting up beautifully in this flat base, putting in a little bit of a handle, but down after 4% down after hours now is Boeing, and that just sucks. Let's go to mid caps. some companies, man, you just can't trust them. Some always deliver, and some set you up for uh, failure. I must say though, recent weakness, any headline weakness on Boeing has been bought up. We got to see if this gets bought up too. The last one was when they had fuselage, easy for you to say, fuselage issues here on 224. That was bought up later, made lower lows. Nice move up here, going sideways the last week and a half, but it'll open down 4% tomorrow. Mid caps. Mid caps, multiple three closes now, including a higher close above the 21-day moving average, downtrending 50-day overhead, also four closes above the 200-day moving average. It's certainly trying. Lagged today, though. And IWM still in this range, this awful range under the 200-day moving average from the banking crisis, but uh, one close above the 21, failed, close below, another close back above. Let's see if we can get a second close above the 21. Not that that's any guarantee. Here you saw two closes above the 21, and it failed last week, but we still have the declining 50 and the 200 overhead. This is still certainly the biggest laggard of the five major indexes. Shift gears now. Here's the VIX making lower lows. People just can't believe this. The bears are screaming, but the VIX is down 6.8%. Lows going back to early February and trending below the 21-day moving average. So oversold here that it started to come off of it yesterday, but hooked back down. Look how you can stay oversold on the VIX. This is 1, 2, 3, 4, 5, 6 weeks. We're only in the third week here, so you can certainly go lower there. That's the VIX. How about the dollar? Continued weakness on the dollar after the failed gap up on Monday. Three gaps down, unfilled. Got off of sold, hooking back down to oversold again. This is a boon for precious metal stocks. We'll go right into those. GLD up 1.4%. Gap up, held, breakout. Note the relative strength though. We've hold some GLD, and if the same amount of money was in SPY, we'd be making more money in SPY, which you can see from the relative strength line here. Higher highs, but not outperforming. Let's look at GDX and look at the same thing. Now that's where the outperformance is. Another gap up, the gold stocks clearly outperforming on a relative basis versus the metal. And SLV, we talked about this 4 days tight that it broke above. This is also outperforming the S&P 500. So gold is really the laggard versus the S&P 500 over the last 3 weeks, while SLV and GDX are outperforming. Let's go to Bitcoin while we're on alternative currencies. Bitcoin up 2% today, continues to hold its breakout. Now let's go to bonds. BNB, broad bonds, barely negative on the day. Note the tight ranges on the broad bond market, but that's not stopping big the big bond TLT from making lower lows. Let's look at this on a 60-minute chart here. We're in this range. Failed breakout here. This is what we bought. We bought the breakout. It failed. We came back into the range and we sold a third of this today. It's still in the upper upper half of the range, which is fine, I guess, but underperforming the S&P. We argue that we don't want to diversify into anything if it's not going to help the portfolio on a relative basis versus the S&P 500. So, you can categorize this as a failure. The short-term bonds, we love those. We know what our guarantee is. There's no coupon on them. They sell at a discount and then they mature. You collect your interest at face value and you don't lose any principal. Same thing with SHV, which we're very fond of. BIL, which we take. This gap down just means that you're getting your dividend. This is all these gap downs are dividend payouts. BIL is the same way, and SNOX just trades at $1. That's a high yielding, doesn't even show the chart. It's a high yielding money market mutual fund invested in treasuries. and it's a constant par value at a dollar, and you just get your interest at the 15th of every month. But TLT not doing the job that we hired TMF to do, which is the leverage portion of this. Uh, really, objectively, it just pulled back to the 21-day moving average. And if breakouts in stocks were failing, should we have expected a breakout in bonds to work? Well, I did because of the weakness in stocks, but uh, stocks have rebounded and bonds have been outperformed. Long-term bonds have been outperformed by stock. Junk bonds, great day today on big volume, acting like stocks. They formed this little cup and they're at the highs. This says there's not any sort of extreme fear of default in the bond market. I keep reading about just brutal price reductions on commercial real estate, but it's not impacting JNK. And let's go to the yields. 10-year yield up with the price being down today, still in a tight range, but again, failed breakout here on the 10-year yield to the downside, and TYX 30-year yield higher. We were expecting this to drop, failed breakout to the downside here after we thought this was a shakeout, and then back to the upside. We're seeing the same thing again, another failed breakdown. We'll handle the position the way we always do with our stop. So let's transition now into the tail of the tape. And you can pause this here. If you want to read the whole thing, I'm going to hit the highlights. So PPI very weak, down 0.5% headline, 0.1% core versus expectations of rising inflation, 1% headline, 2% core. So this was a very big miss to the benefit of the market because it means the economy is weakening, inflation is slowing, and that means that the Fed is going to get closer to stop raising interest rates. This dropped today. We're now at 66%. It was 70% yesterday. We also had jobless claims rising versus expectations. This is another thing that the Fed, in their sadistic goals, wants to see. They want to see more people lose their jobs to tame inflation. And it's like the whole needs of the many outweigh the needs of the few thing. Spock used to say that on Star Trek all the time. I know I just uh, let everybody know exactly how old I am. But inflation is an economy wrecker and a country wrecker. They've got over 100% inflation in countries like Venezuela, Turkey. It's just brutal. And I can't imagine living that way. I feel terrible for people that have to, and that's why everybody's streaming through the southern border. Anyway, day count from the 6-day consolidation to up one. If this up one fails and we go back in here, we'll go back to the consolidation count because it's very clear on the S&P 500 and the NASDAQ 100 how we are, in fact, consolidating in this range, 4070 to 4033, 4034. We broke out today. So ideally, we will back test 4130 pivot and bounce off of it. That's what you want to see from a breakout. Where was I here? Okay, 14 days above the 80 EMA and the 21 EMA. Confirmed positive, staying above the 21. Obviously, we're in range between support resistance and resistance on the S&P. Failed at support resistance level yesterday, but only one day, and that's really good stuff because there's this level 313.68 was the pivot. We got back above it. 315.58. 59 is a big fib level. We got back above it, so we regained support and resistance there, a big positive for the NASDAQ 100, which has been lagging, as I said, on a relative basis. So here was the action on the day. Open up 0.3% base, up to 4120, base up to 4149, and then base into the close. The only weak sectors, the dollar, ITB, and XLU and XLRE. On the plus side, we've got gold, silver, gold and silver stocks, bond yields, software, biotech, banks, including regional banks, Chucky, that's CKY, the 3 tech sectors, and solar. We're going to look at these charts here momentarily. So portfolio changes today. We added to NVIDIA. on the 268 breakout, had everything going for it. I really like this setup. We all talked about it quite a bit. And sometimes, they just don't work. Look at this 60-minute on NVIDIA coming off of oversold on the 60-minute chart. Look at all of the prior times that it did this, what the outcome was. There are no absolutes in the market. We got the stochastics right where we wanted them to be on a short-term moving average. We bought 268, it ran up to 269, and it just failed late day. There's more sellers than there are buyers in NVIDIA. If you're thinking long term, you can. And NVIDIA is just at the lower end of this range. So you could argue that you just buy the lower end of the range. But if this breaks the 21, we're probably going to trim some of the position and put it into something that is not showing this relative weakness with three lower lows on the relative weakness chart, and it can come down quite a bit further. In fact, there's a head and shoulders here that measures down to like 248-ish, which would be the 50-day moving average and the top of this recent base. And that would be completely normal action to be the first close down to the 50-day. But I don't want to give this position another 9% down. I just won't. I can buy it off the 50-day or when it pulls back there or the 250 level. Um, Somebody also asked me today, and it was a great question. TMDX broke the 50. Why didn't you sell it? The volume has been light, and this 70 area, look at how it was resistance multiple times throughout January and early February, broke out on the gap up day on the big volume, 500% volume, up 20%. The lower the gap day is right below 70, pulled back to 70 right here, got up, consolidated. Now it started selling off again, but this 70, you come to a point to where even though you're below your moving averages, you can be so oversold and at such strong support that you just got to give it a little bit more of a chance. So there's rules and there's times when you got to know what overrides some of the rules, and this is one of those times. Now, if this volume spike on the week were like all the way up here and it was the strongest volume week, I'd certainly be considering selling it. I commented on Twitter on an Apple chart today about the situation, about how there's no way I could ride through that. In fact, look at this. This would have been a sell for me through the 50-day on massive volume. But we're not seeing the volume. In fact, the volume has been very light the last 4 weeks, comparatively speaking, on TMDX, and we know the story. And the story is, we'll knock your socks off. But that shouldn't override price. But in this case, we're just giving it a little bit more room because of the massive support level here at 70. So a good question from one of our followers today that just made perfect sense. And I'm really taking much longer than I should be with this video. So we added to the video. We bought NRGU, energy stocks, basing very nicely. Commitment of traders show very few shorts. That's typically a bullish sign for oil. And then, as I said, we trimmed TMF. So let's bottom line this. PPI gap up turns into a trend up day led by the big QQQ names, with the lame exception of NVIDIA. Let's go now to this Titan-25. I've been talking about this. And what I've basically been saying is there's no way the indexes can break as long as the individual charts on these 25 names continue to act well. They're huge representatives in the S&P, the NASDAQ 100, and the Dow, and here's their breakdown in the percentages for each. So the top 13 of the S&P, it's about a third. And this is my initial attempt to gauge how strong or how weak they are by putting them into categories. 60% of the NASDAQ 100 is these 12 stocks. 61% of the Dow is the 12 stocks listed here with the percentages. So keeping an eye on these. As long as these charts stay fine, there's 25 of them, the Titan-25, and it's not all tech. It's 16 different sectors among these top 25 stocks. So it's broad strength, enough broad strength to keep the market up. Yeah, I'm not going to argue that Apple and Microsoft are just massive percentages of the S&P and the Q, but they're not on the Dow. UNH is. UNH had a garbage chart for a while, but Microsoft is the biggest weight in here at 5%, and that's trailing UNH, Goldman Sachs, Home Depot, and McDonald's. And Apple's all the way down at 3%, which is the 11th largest, according to this chart. So a lot of versatility here and diversification from a sector standpoint on the Titan-25, and I'll keep this going forward. Now let's just hit real quick these 9 charts. This is something else I've been doing, gauging the rotation, what's strong, what's weak on these spider charts. The 11 sectors. The sector rotation has kept the S&P 500 afloat. Here's basic materials back above all the key moving averages. Energy forming a nice tight consolidation over the last 2 weeks after the production cut by OPEC. XLC, communication services, there's nothing wrong with that. It's approaching new highs. Financials, we know all about the move down here from 37 to 30. We're rebounding now, though, back above the 80 MA, multiple closes above the 21, 2 of the last 3. Let's see how the week closes. Industrials, terrible sell-off in some industrials over 3 days of last week, regained half of it, back above the 21 EMA. XLK technology, just going sideways. Relative strength lagging a little bit, but we've been talking a lot about this because it's the big FANG names. But it broke out before the broad index, S&P broke out here. So it's just been doing some pulling back and some consolidating. Consumer staples acting great. It's a defensive sector. Money flows in there. If the economy is weak, if you're seeing strength across the board in all the sectors, which is what I'm getting to here. Here's XLRE. This is one that we've been avoiding because of the plunge that was exacerbated by banks. Got back above the 21. It's been consolidating above the 21 for 2 weeks now. Can't argue with the chart. XLU, safe haven during the banking sector, banking crisis. Money's flowed into it over the last 2 weeks. It's right into the 200-day moving average. And then healthcare, new recent highs. And consumer discretionary, this is supposed to be the weakness, and it is on a relative basis, but it's all around the stacked moving averages. And the bottom line is that when 11 out of 11 sectors are above the 21 EMA, including great action from 25 Titan stocks, the market's not breaking. You can read all the bearish headlines that you want to. You can see all the negative reversals in the charts that you want to. We see them. We don't like them either. Even though there's a lack of leadership, the leadership is in the indexes, UPRO, QLD. You can buy the Dow. And until those 25 charts break, the market's not going to break. And with that, I will remind you that it's not how much you make in the market, it's how much you can keep. Our job at Revere is to keep you from severe losses. Let the gains take care of themselves when the market corrects. Usually we count on leading stocks to do that. We've been leaning more on sectors to do that. And that's just the market. You don't get the market you want, you get the market that you get, and you better make the best of it and not argue with it. And that's where we are. So as I said, it's not how much you make, it's how much you can keep. And with that, I'm going to wrap up Thursday, April 13th. Don Vandenbord with the Revere Asset. Just the facts here at Revere, telling it like it is, 5 nights a week and a podcast. Thanks for listening and have a great day.